you were sharing with us already about the intrinsic value.
Now let's do a hypothetical. So let's say now it's 2 years in the future.
Right.
Joe came to work for me. He got his option grant at $5 per share. And let's say over the past 2 years, the GMZ stock has doubled from 5 to 10. So now Joe he's 2 years in, and we said 25% vesting per year. So half of the 10,000 options are vested, so 5,000 options are vested. The current stock price at 10 minus the grant price of 5, so each of those options is $5 a share in the money. So in order to compute the intrinsic value of those 5,000 options, you take $10 a share minus 5, which is 5, multiply by the 5,000 vested options, and Joe now has the opportunity to collect, call it a paycheck, of $25,000 less taxes. We talked about intrinsic value, so what are those worth from a very tangible point of view? Well, we said with the current stock price of 10 and the strike price of 5, that those options are $5 a share in the money.
Right.
And if you take that $5 a share in the money times 5,000 vested options, then Joe has the opportunity to collect $25,000 worth of stock.
Right. So it's like having a
Actually, technically, he can pick up $50,000 worth of stock for a $25,000 outlay, if we really want to be technical about it.
Right. So he's got like a kind of like a half-off discount that he gets to use.
Yeah.
If he wants to.
Yeah.
Okay. And so that was our calculation right there. You take, so your intrinsic value is the number of shares that are vested right now.
Correct.
Because the unvested part doesn't have any intrinsic value.
Right.
And
they do, but he doesn't have any access to it.
He doesn't have access to it. Okay. And then it's the current price minus the grant price. So here we've got $25,000. Great. So, but there's another type of value that can apply to this, and that was the time value you were saying.
That's correct.
So.
And that's a very intangible calculation. There's a couple of ways to do it, and I'll throw out a little jargon. Black Scholes is a method for calculating a value of an option during its lifetime. To take into the account the fact that based on the volatility of the stock, that option could be worth something or could be worth more than the current value during its lifetime. And so I don't want to go into the technical details of it, but Black Scholes is one way to apply a value to this time value. Another is binomial lattice, and that's probably all I want to say about that at this point.
I think that's fine with me.
It's just a way to quantify, how much is this option worth more than just the intrinsic value.
Now, I don't want to go too into this because I know we're going to touch on this again later on in the discussion here, but we're talking about the time value, and I'm thinking, I can't sell these options to somebody as options, right? They're only mine to either use or not use, right?
Generally not, no.
So having an intrinsic value, there is a benefit to knowing that intrinsic value other than just being able to sell the option.
Yeah.
Which is something we're going to come back to.
Yeah.
Later when we talk about the financial planning aspect of this.
Yes.
Okay.